Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Hi, everyone. Welcome to the Bloomberg Businessweek Weekend Podcast. So we were recently in San Francisco broadcasting from Schwab Impact 2024. It was just over a week and a half ago. We were surrounded by some 4,500 attendees. This is Schwab's annual conference for independent registered investment advisors, RIAs, and also the independent record keepers of Charles Schwab. What it does is it brings together advisors from around the country and those in the industry that support them with services and tools. It was a lot of folks.
A lot of people there. And for the next 2 hours, we're serving up highlights from the event and interviews with various members of the Schwab universe, including the company's top strategists on U.S. and international markets, also fixed income. We're also going to hear about growth in the wealth management and ETF businesses.
Now, we just want to point out, at the time, President-elect Donald Trump had yet to name his pick for U.S. Treasury Secretary. His choice, Wall Street veteran Scott Bessent. It came after Schwab Impact was over. We're pointing this out because we know this is one of the top jobs in an administration that is closely watched by global investors and Wall Street alike. Who is the U.S. Treasury Secretary, folks? It matters.
And so it wasn't a choice yet public when we sat down with the president of Charles Schwab, who also happens to be the incoming CEO of the company as well. We're talking about Rick Wurster, who takes over the top spot on January 1st.
Even so, we had a lot to talk about as Charles Schwab recently reported earnings. The stock, by the way, did rally on that earnings release, and you even had a couple of analysts raising their price targets on the company. This as core net new assets brought to Schwab by new and existing clients came in at $24.6 billion. Total client assets are now approaching $10 trillion.
We kick things off with Rick Wurster, looking at the big themes he's hearing about at the event.
The big theme to me is always, what can we collectively do to make a difference in the lives of everyday investors? You mentioned the number $10 trillion. It's an overwhelming number, but behind every one of those dollars, it's a grandparent who's trying to help contribute to their grandkids' education. It's a family that's trying to take a nice vacation that they've been saving for. That's what matters to us.
I love that you say that, because as I walk around and talk to some of the advisors, there may be $1 billion shop, a $2 billion, maybe even smaller, and they're always kind of apologizing. I'm like, no, you're the guys who are managing everybody's money. I kind of love that perspective.
Absolutely. And the thing about this community, we serve 15,000 advisors. They're in most communities across our country, sitting down to the table with people, helping them understand how to live their best financial life. And the power of that is so impressive.
Rick, no doubt about it, the elections continue to come up. How are you thinking about the elections, the impact that a new administration, new people running, different regulatory bodies, certainly that play into the financial industry, how it might impact Schwab?
Well, there's a lot of potential change at play. We've heard a lot of proposals. It will be really interesting and important to watch how those play out. And we stand ready to do whatever we can to help the everyday investor. That's our focus, and
do you think things change much because of a new White House and a new team? Do you anticipate, from what we've heard on the campaign trail and some of the people that are being considered for positions?
I certainly think that there will be change, absolutely. I think with any administration there's change, and we've been through all sorts of presidential cycles and election cycles. And at the end of the day, what it means for us is we adapt and we do whatever we can to help the end client.
Well, how are you thinking about this from a regulatory perspective? We did hear that SEC Chair Gary Gensler is going to step down by January 20th. Certainly the crypto community cheering that. How do you look at a change in leadership at the SEC?
Well, for us, our company is built on trust and has been for 50 years. Our entire industry is built on trust. If people can't trust their financial institution, the whole premise of what we do goes away. And so I think regulators play a really important role in that. And we've always had a great relationship with regulators. I think from our perspective, we want regulation that is thoughtful and makes sense for the end investor. And when that's the case, we'll do anything to support it. And we're looking forward to seeing who the next chairman's going to be.
Rick, what does it mean for crypto? And I'm curious if you guys see yourself getting into the crypto business. Here we are approaching $100,000. We have a president who initially or president-elect who maybe wasn't so into crypto is now very interested in it.
Now he's got his own crypto company.
What about for Schwab? What's the play here? Do you see yourself getting into it?
Well, we're in the crypto business
even more
today.
Aggressively, yeah.
We have lots of different ways for clients to participate. They can buy ETFs today. They can buy Bitcoin futures. They can buy closed-end funds. I think we will get into spot crypto when the regulatory environment changes. And we do anticipate that it will change, and we're getting ready for that eventuality.
Is there some, I don't know, is it growing up in your view?
I don't know. It's an interesting asset class, and people have really gravitated towards it. And, we never like to judge what people want to invest in. People on our platform, we think, are very thoughtful investors, very sharp. They make decisions about what they want to invest in. And crypto has certainly caught many's attention. And they've made a lot of money doing it. I have not bought crypto, and now I feel silly. So they've been the ones making all this money on crypto.
Are you thinking about buying it now?
Me personally, no, but we certainly support our clients that want to do that.
You answered my next question, which was going to be, do you own any crypto? But talk a little bit about that, because it's always interesting hearing from somebody in your space about their views on something. What's holding you back?
Well, I think what's holding me back is just a question around the true value of crypto. I like to invest in stocks, and with stocks, there's cash flows you can rely upon. There's dividends that accrue to you. With crypto, it's less certain what that will be, and it's less certain how to value it. So, to me, on a personal level, that's what makes crypto not something that I invest in. At the same time, we encourage our investors to invest in what matters for them, and I've talked to a lot of our investors who tell me I'm completely missing the boat, and they tell me all the great things about crypto. And you know what? They've been right, not me, because it keeps going up.
So far, they've been right. We'll see.
It's one we're going to continue to follow. It moves around a lot. It is a competitive space. Just this week, I just want to look at my notes. Robinhood announcing they're moving to the RIA space. I'm curious about how you were thinking about Schwab for the next 50 years as you get ready to take over as CEO. Not a new thing. Traditional investors, they're getting older. Younger investors, how they want to play and have more options. So what are your thoughts about Robinhood's move and maybe what you guys need to continue to do to attract younger investors who want those more options?
Well, for 50 years, our central theme has been to see through clients' eyes and do right by them. And we attract a lot of young investors to Schwab. In fact, 60% of our new-to-firm clients every year are under the age of 40. Our client base actually gets younger every year. So it's sometimes we're not thought of as that way, but we attract a lot of young investors because we have what we think is the best trading platform in the industry. And it also comes along with what we think is the best educational and training platform in the industry. And that aspect has really appealed to some of our younger, newer investors.
Got to ask you about the training side. And talking with advisors here, I was up on the stage doing a panel on artificial intelligence. And so many people came up to me afterwards and they're like, we got to talk to Schwab because I think we need a Schwab chatbot. AI, though, is impacting everything. How are you also, acknowledging, thinking about how that needs to be incorporated into what you offer up the advisory space?
Yes, so that comment about wanting an AI chatbot, what they don't recognize is that actually behind the scenes we have built one for our client-facing professionals. And so it used to be that 60,000 times a month we would have a phone rep spend more than 3 minutes searching for a piece of information to answer a client question.
Right.
And now we have built an AI capability that finds that information in seconds. And so it makes a better use of the client's time and allows them to focus and go deeper on wealth issues that we could potentially help them with.
But is there another level that you continue to think about? Okay, where does this go in helping advisors in terms of portfolio management or building out their businesses?
I think AI will have a really big impact on our industry. I think it will do a lot to help us better serve clients, to empower our professionals, to give them the right information at the right time.
Right.
I think it will also allow us collectively to help serve clients that we couldn't otherwise. We have 15 million retail clients. We can only have a person-to-person relationship with about 10 to 20% of that client base. There's 80% that we don't get to have that in-person dialogue with, and I think AI could bridge that gap and allow us to reach more clients.
Hey, before we let you go, I want to talk a little bit about the balance sheet, because you basically said you're trying to shrink the bank's balance sheet and not hold as many loans on the balance sheet, given what happened a couple years ago, close to 2 years ago with the regional banking crisis and the way you guys were brought into that. Just give us an update there on what you're going to do when you become CEO.
Well, I want to clarify. We never said we wanted to shrink our balance sheet. What we did allude to, and I think what you're referring to, is on an earnings call, we said as our balance sheet grows, we would consider using a third-party bank to take on some of those deposits. That's something that could make sense for us because of the way the economics work. We have to hold capital against deposits. We can send some of those deposits to another bank and earn earn a better return relative to capital when we do so. So it's a tool to have in our toolbox. It's not something we're going out and doing immediately. It's something we're considering. We'd only do it as our balance sheet grows and when it makes sense to do.
Challenging year, certainly for Schwab, with the regional bank crisis and so on and so forth. We talked about a lot on Bloomberg. Are we past it? Do you feel confident? Or what's more to be done in terms of the impact that we've seen in the past year?
I've never been more optimistic about our business than we are today. We're number one or number two in the two fastest growing segments of the financial services landscape. And our client satisfaction scores have never been higher than they are today. So we're hitting on all cylinders as we roll into 2025, and I couldn't be more excited about it.
What's the most interesting thing in the investment space, do you think, right now?
I think the engagement among clients. It's just wonderful to see how engaged they are in markets and their financial life. When people own their tomorrow, they tend to have great financial outcomes.
Rick, thank you so much. I know there's a lot going on. I know this is a big event, but carving out some space for us, we really appreciate it.
Well, thanks for making the commitment to be here. We love having you here.
It's a great perspective that we get to come and take back to New York and kind of share with some of our other guests. Rick Wurster, current president of Charles Schwab, taking over CEO on January 1st. This is Bloomberg from Impact.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business App. Or watch us live on YouTube.
Time now for a strategy deep dive, courtesy of the team at Charles Schwab. Everything from global equities and macroeconomics and presidential politics to fixed income and U.S. domestic stocks. It all happened recently when we broadcast from the Schwab Impact Conference in San Francisco.
At the event, two very familiar voices to investors and the Bloomberg world. From Charles Schwab, Liz Ann Saunders, Managing Director, Chief Investment Strategist. Also, along with Kevin Gordon, Director and Senior Investment Strategist.
We want to note that this conversation happened before President-elect Trump vowed additional tariffs on Mexico, Canada, and China. That all happened this past week.
We began by asking about the conversations they're having between each other about what's going on in the market.
It's just such a unique period of uncertainty because of the different directions policy can go. And one way we've been talking about it is we're all always mindful of sort of tail risks. I think the tails are fatter. Because of not just the uncertainty associated with tariffs, immigration policy, but the fact that much of what appears to be the priority of the administration can be done via executive order and doesn't have to go through that congressional. And we learned in 2018 that, a lot of the tariff announcements were done by Twitter. So it's unconventional.
So then how do you think about, what can you kind of hang your hat on? Kevin, come on in on the conversation.
Well, I think, one of the hard parts about going back to 2018, 2019 is, as humans, it's natural to go back to a period of time and say, yeah, you can bring out that playbook, dust it off, especially from a tariff perspective. What's harder this time is that we're in a totally different macroeconomic environment where you're still dealing with ripple effects from the pandemic. You're still dealing with a bond market that is a little bit more unruly this time than it was going into the first administration for Trump. So I think that, to Lizanne's point about what can be done unilaterally versus what can be done with congressional approval really needs to be looked at here, especially from an immigration policy perspective, because most of the labor force growth we've had over the past 4 years has been from the foreign-born, workforce. So that, if it gets restricted, I think could be more of a problem.
And then the Fed comes into the mix because the combination of immigration policies and tariff policies, it's hard to argue against them being inflationary. Mm-hmm. So then you have what's the Fed reaction function if it's policy-driven inflation?
I based on the first Trump administration, I believe, and I'm not getting political here, I'm just stating sort of a theory. The president-elect loves to look at the S&P 500 and talk about the S&P 500. That's like his report card for how he's doing. If there is an adverse market reaction to one of his policies, I think that would be enough for him to change his tune.
I think not just the S&P 500. I think markets could be the decider, and not just the equity side of things, but the bond market side
bond
of things
vigilantes?
as well. Yeah.
I think the other thing, too, to keep in mind is it's not as if, because, we know that President-elect Trump is very focused on markets, that doesn't mean that you don't get downturns and you don't get volatility. I mean, if you just use 2017 as a case study, if I came from the future and we were in 2017 and told you we were going to get this massive fiscal stimulus in the form of tax cuts at the corporate and the individual level, you'd probably think that's nirvana for risk assets. But the reality is we had the short vol implosion in 2018. You had a near bear market almost by 1/10 of a percentage point for the S&P in the fourth quarter of that year. And yeah, you bounced back in 2019, was choppy, but ended up being okay. But it doesn't mean that you eliminate all of this downside risk, especially if it's driven more by tariff-related news and the hits to manufacturing in the U.S. that are associated
Speaking of
with
the
it.
hits to manufacturing, if you look at the ISM Manufacturing Index and put a vertical line at the start of the trade war in 2018, it went straight down.
Mm-hmm.
Now we're at lows in manufacturing, so I don't know that we have a potential implosion from these lows, but it could be something that prevents what was the hoped for pick back up in manufacturing.
I guess I keep thinking about, there's the fundamental stories of companies and profits, right? That really matters. But then you've got to layer on top of that the politics that's going to play out, and that's going to kind of kick investors around. I mean, how are you guys squaring when you're going to have a client call up and say, listen, fundamentally, earnings growth is happening, but here's
but keep in
how do
mind
you
that
do that?
if you're proxying earnings growth at the S&P level, that's obviously biased up the cap spectrum. You've got 43% of the Russell 2000 are non-profitable companies. You've got a similar share that's zombie companies. So I think there's a much wider spread, especially when looking on the cap spectrum. But it often gets masked by virtue of there's so much focus on the large cap indexes.
Well, funny that you say that, because I feel like the last 2 weeks, everybody keeps coming on and said, guess what? It's small caps' turn again. So is it?
But not monolithically.
Okay.
Again, when you look at an index as large as the Russell 2000, to sort of just blanketly say, yeah, small caps look good, I think that there are interesting opportunities.
I heard zombie companies that you said.
Yeah, those with not sufficient cash flows to pay even interest on their debt. So I think our thesis around factors has been, yeah, there's opportunities down the cap spectrum, but you don't want to sacrifice quality.
Yeah.
And to that point about quality, I mean, if you just used positive earnings on a trailing 12-month basis, so earnings of EPS above zero as your only criterion for the Russell 2000, and you took all of those companies, it's about 800, 900 and change. As a group, on average, they're up by almost 45% over the past year. So there are pockets of small caps that have worked. It's just not equally distributed because of the interest rate environment we've been in and also the growth environment. And by the way, all of these pops that you've had in the Russell 2000 from time to time over the past couple of years, every time they get a little bit of momentum and everyone thinks it's changing for them, it hasn't been consistent with the turn in forward earnings growth and expectations. So until I think you see that actual move where conviction starts to build from an earnings standpoint, it's tough to get bullish on the index as a whole. But to Lizanne's point about a large chunk of it being not profitable and zombie-like, it's just tough to look at it monolithically.
Even within the NASDAQ, if you look at the top 10 best performers this year in the NASDAQ, none of them are large cap stocks. They're all small to medium cap. None of them are in the Mag 7. So I think we get in this sort of tunnel of the mega cap tech and tech related names, and there's less analysis happening on everything else.
On an index level, Lizanne, are you concerned about the power of those mega cap tech companies? It's a question I could have asked 5 years ago. It just wouldn't have included NVIDIA.
I think the problem of concentration and the perceived need to be in those names in order to do well, that's an institutional problem. That's not an individual investor problem. If you're benchmarked against a cap-weighted index, you are at the mercy of what those largest names, their contribution to the index. But for individual investors, they're not benchmarked against the S&P 500. They don't have to take that same kind of concentration risk. And it's another point behind that, what I just mentioned of, top 10 best performers in the NASDAQ. They're all small to mid-cap stocks. Only one of the Mag 7 is in the top 10 best performers of the S&P 500.
Right.
So I think you don't need to have that concentration risk if you're not professionally benchmarked against the S&P.
What do you think are the biggest risks right now? Do we have clarity on it for 2025?
I mean, from a policy standpoint, that's probably the easy one to throw out there. But I think just the lack of clarity from
policy, meaning government,
Washington
or also
policy.
Fed policy?
More Washington policy, but I think they're tied together now.
Yeah.
Because I could see a scenario where if you do get more restrictive labor force growth coming from the outside, but also if there is a chunk of the labor force physically removed from the country, that's probably an inflationary problem. And I've also yet to see...
I love that you guys are going there, because I don't think people realize, we certainly hear it from CEOs, that they are so worried that they're not going to have access to a labor force and what that means for their ability to do things.
100%.
It's an increase in the cost of labor.
Labor costs, right?
And it's a decrease in labor supply. There's the demand side of that as well.
It's a supply shock and a demand shock.
I can't get a CEO to seriously explain that will affect them at this point in the last 2 weeks. Even if they don't employ people who didn't come to this country illegally, right?
How often do you talk to smaller company CEOs?
I recently
we do actually talk to a
we
fair
do. I talked to
in the spaces where migrant work is a larger
construction,
share. In construction,
services, hospitality.
For construction, I mean, almost 20% of the construction sector is undocumented.
I have two brothers
workers.
who are contractors. They can't find work.
Yeah.
But I think the important point is that it's not just you could run a company that doesn't employ any undocumented workers. You're still going to see labor costs rise
Right.
if 11 million people are taken out of this country who are doing work.
That's right.
Yeah, it's a demand shock, it's a supply shock. And I think we sort of lose sight of the fact on the demand side, especially because the supply side is looked at maybe sometimes more of an issue in terms of the makeup of a particular industry or the makeup of the labor force. But if you're taking demand out of the country, but you're also not being able to fill the supply hole that you're leaving, that's sort of a stagflationary shock.
So what does it do to the market if that policy ends up coming to fruition?
Well, I mean, I think it depends if it's phased over time. But
and you know, we don't know the logistics around whether we even possibly could get to the high end of what the campaign pledges.
The reality
were on
of it,
that
right?
front. But Peterson Institute, I don't know if you guys saw it, just did a study on, okay, let's take it to the extreme. Both on the immigration side of things, on the tariff side of things. And they actually added an interesting little wrinkle into the mix if there continues to be a threatening of Fed independence. All three of those collectively are unquestionably higher inflation, lower growth kind of backdrop. Now, we the real answer may be somewhere in the middle of nothing gets done and the extremes, both on immigration and tariffs.
But it's a wait-and-see mode, right?
Yeah. Even on the tariff front, I've yet to see a model in all the research that we read. I've yet to see a model that doesn't suggest it's a stagflationary shock, where over time you get this boost to inflation, but you also get a hit to growth.
I want to go back to the market as kind of a clearinghouse for all of the information, because I do feel like the market smacks down policies or initiatives very quickly. I feel like much more than it did, 10 years ago. Maybe it's because of social media and stuff just filing through. Do you assume that will continue and that will send messages to Washington and maybe so that things aren't so severe?
It will send messages. How much they're heated, that's we don't know. But
especially when I think about the Fed and the independence of the Fed, like that to me would be something that would bring down the markets.
To me, the most fascinating part of Powell's press conference at the most recent FOMC meeting was the definitive no. As soon as that happened, I thought that's the headline, and that should be the headline. So I don't worry about that piece of it all that much. But one of our theses is that this sector dispersion, these rapid-fire rotations that are happening at the sector level are going to persist.
Yeah.
The drivers going forward may be more specific to things like tariff policy announcements. And we saw that in 2018. There was, that voting mechanism that happened so quickly with markets maybe doesn't appear acutely at the broad index level, but I think you're going to see it at the industry level, at the sector level, tied specifically to both tariffs and immigration.
Makes sense.
Kevin, I believe a year ago we were sitting here, it was October of last year in Philadelphia. The S&P 500 is up 40% since our conversation with you.
Who'd have thunk?
Who would have thunk?
And what was interesting, too, I remember talking to you guys about the unique nature of this bull market, and at that point it had been so unique where even for something like small caps in the Russell 2000, it was breaking new bear market lows, and that has just never happened before. You also had sectors in the S&P that had not been up, and that was just so unique about what the structure was of the bull in its early phases, where typically, even after you go through a non-recessionary bear, you do tend to see a lot of participation at any sector level, at any cap level, but we just haven't seen that. But I will say, and what's been nicer to see this year is that participation has really improved, especially since that midsummer mark where
a broadening
the Mag
out, right?
7 really started to take a little bit of a step back, not outright decline, but take a step back. Tech took a step back. Even semiconductors recently, I find the weakening in that breadth profile actually just fascinating, while the rest of the market has actually been able to power forward. And that's, I think, what has actually been lost in all of the election-related narrative recently, especially around some of the strength around areas like financials. Financials were strong heading into the election. Industrials were strong heading into the election. So it's not as if you got this massive shift in the leadership profile of the market, and I think that's been a relatively healthy thing.
But all year there's been massive churn under the surface of these cap-weighted indexes. So the NASDAQ had a 13% drawdown in that, midsummer period of time. But the average member drawdown for the NASDAQ is 47% year to date. So sometimes when people talk about the market, it sort of begs, well, what piece of the market are you talking about? These cap-weighted indexes.
I love that you do that. I know we all throw it all in one basket, and it's
right.
It's dangerous, actually.
And we've been for a good chunk of the year, we're calling it the Michael Caine duck market. Just calm on the surface, but paddling like the Dickens underneath. Yeah. That's been how we've been describing it.
So all right. So what's the environment for 2025? Can you make a call?
Well, we never make a call.
Okay. But what are we missing? We haven't had a recession. We have had pockets of recession.
We've had the roll through.
So are we done with it then?
My hope was that we were going to get to a point where if we started to see weakness show up more acutely in the services sector, in large part probably driven by any further weakness in the labor market, that especially if the Fed was in easing mode, you might be in a position to see stabilization, if not recovery, in those areas that have already taken their hits, like manufacturing, like housing. I don't want to say that's off the table now, but it's a little bit more difficult post-election to come up with a case for stabilization and improvement in those areas, especially if the Fed doesn't stay in easing mode. We saw this attempt at some recovery in housing, and then it faltered again, courtesy of the move up in long yields.
I think the other thing, too, from a valuation and a sentiment perspective, is that you're getting pretty stretched across most of the metrics that we track. And it's not just in the traditional attitudinal, how do you feel about the market, AAII, bull bear indicator. It's now filtering over into what are investors actually doing with their money. We've seen equity ETF inflows completely spike, akin to levels that you saw in 2021.
But money market funds, too, continue to blossom.
Absolutely, yeah. So I think that becomes a little bit more of a risk in the event there's a negative catalyst. We always say frothy sentiment in and of itself is not a reason that the market just goes lower. It has to be tipped in that direction. It's just the sentiment backdrop that makes things more vulnerable.
I also don't think we should look at the money in money markets as some giant pool of imminent funds dying to go into the equity market. I think a lot of that is pretty sticky money.
That's exactly
Maybe
it.
1 trillion, 2 trillion will go into the equity market?
Maybe, but not as powerful as
But not necessarily the equity market.
You got to run. Lizanne, thank you.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business App, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
From stocks and the macro to fixed income and the macro. This past week, U.S. Treasuries added to the gains spurred by the announcement of Scott Bessent, a Wall Street veteran who investors expect will take the sting out of the administration's more aggressive trade and economic policy proposals as President-elect Donald Trump's Treasury Secretary choice.
We also got the latest FOMC minutes, which you can, of course, check out on the Bloomberg terminal. And as we continue our coverage from Schwab Impact, which happened about a week and a half ago, we talked with two members of the Schwab team who focus on fixed income strategy. We're talking about Kathy Jones. She's a managing director, fixed income strategist, and also Colin Martin, director, fixed income strategist.
We started by asking Kathy if her view of the Fed changed at all since the election.
I think the case for a pause is growing a bit stronger at this stage of the game. So, we've had stronger than expected economic data now for a while, particularly like the retail sales telling us the consumer's doing well. And so then the question is, does the Fed really need to cut rates to help out? We have very easy financial conditions as the stock market keeps going higher and credit spreads get tighter. And so, and then we have all the uncertainty about what fiscal policy will be going forward. We don't know what tax policy will be. And then immigration reform, which I particularly think is one of the most important components for inflation and growth going forward, because, again, we don't know what the actual policy will be, but if you kind of take things at face value, that could reduce the workforce by 7 or 8%. That's a huge issue.
So, Colin, you and Kathy have to figure out, though, fixed income strategy and what you're thinking about, right? People look to you to kind of get an idea of what's to come maybe in 2025. So what do you feel comfortable kind of saying about that?
Yeah, well, we've kind of revised our guidance a little bit lately because of so many of the uncertainties that Kathy just highlighted, where there's this wide range of outcomes because of the proposed policies what gets implemented, when they get implemented, and what that impact is. So given that, and given I think the risk is to higher yields than lower yields if we do get some sort of inflationary impact. So our guidance now, our main guidance for investors is to really focus on a benchmark or below benchmark average duration. We don't think it makes a lot of sense to dive in with long-term bonds right now because of the risk to those prices if they fall. I want to make it clear, though, that's a tactical idea. From a strategic standpoint, we still think the yields are pretty attractive. So if you're an investor, you're looking for 4%, 5%, 6% yields, you can get that right now if you have that time horizon. And if that's going to help you reach your goals, then I think that's really attractive right now. But just be prepared that if we see yields inch up, when we talk about our upside, maybe we go to 5% on the 10-year Treasury yield.
Wow.
But likely, possibly?
Possibly.
Yes.
Okay.
So all three.
Yeah. So, what we do is we try to model out, we deconstruct the 10-year yield, and we try to model out, well, if we change this component, what happens in that component? Or if you just look at the spread between...
There's a lot of components to play around with right now, right?
Exactly. Yeah. Or you just look at the spread between the Fed funds rate and 10-year yields historically. It can be, 100 to 150 basis points. So if the Fed can't go below 4%, you could easily get to 5% plus just based on history. But we do think the Fed will get below 4% by some amount. But again, a lot of ifs in there. And so we're just trying to be as cautious as we can right now without giving up too much income.
Hey, Colin, play that scenario out for us if we do hit 5% on the 10-year. What that looks like, what the implications of that are for the economy. And, I think a lot about different areas of the market that have expected lower interest rates. If we don't get those, what happens?
So I think what it looks like, I think it looks attractive. And I think if we get there, I think that can draw in a lot of demand. I think whether it's domestically or internationally, I think there'd be a lot of demand, especially that we're seeing these interest rate differentials. We're seeing other central banks expected to cut more than the U.S. So I think that's number one. Two, what happens to the economy and to borrowers, I think it's more of a mixed bag right there, because if you look at both the consumer side of the equation and what I focus on in the corporate bond market, corporations just haven't really had that negative impact of rising interest rates. Something I've looked at recently is...
Why?
So because they did the same thing that homeowners did. They locked
the refi,
in,
right?
They refied. So if you look at, I'll use high yield bonds for example. The average,
which is having a moment.
They're having a moment. Spreads are at 15-year lows. The average coupon rate. Now there can be higher or lower, but the average coupon rate of that index is right where it was in 2019. It's risen a little bit over the past year or so,
right?
But because companies just refinance. So if rates keep rising from here, although the trend is the opposite right now, but if they were to move up a little bit, that would impact the leveraged borrower. But for the most part, their fundamentals are pretty strong.
So the opportunities, so when, someone comes to you and says, so where are the best opportunities right now? If I want to put some money in the fixed income area, Kathy, what do you say?
Well, again, if your time horizon is 5 years plus and you're willing to kind of ride out the ups and downs, you're looking at 5 to 5.5% yields without taking much credit risk. So it's either investment grade corporate bonds, treasuries, MBS, if you just look at the ag. Your total return is going to be pretty attractive, and your income stream is going to be important. So keep in mind, we had a rocky period in 2022,
right? Because
there was no coupon income. We're coming off zero. Now we're starting with coupons, close to 5%. That keeps your return much more solid going forward. So we like higher credit quality in general, but definitely lots of places to lock in that yield.
Oh, go ahead. No, you go.
I wanted to talk a little more macro and think about policies come January, because, Kathy, you mentioned a lot at the top when it comes to the labor market, when it comes to tariffs. Do you believe these policies are actually likely to be implemented, given that they actually could have severe economic consequences?
I have no idea. And I will be honest with you, because we know that one thing that President-elect Trump has been in favor of forever is tariffs. So we do believe pretty strongly there'll be some sort of tariffs. Now, will they be modified? Will industries affected by the tariffs be subsidized as they were in his previous administration with the farmers? We don't know the details of that, but tariffs seem very likely. After that, really hard to say. Tax policy and immigration, hard to say what will really happen.
Just got about 30 seconds. Is there a moment in time that you're thinking, okay, maybe 6 months from now, 8 months from now, we'll have much more clarity about what this new administration can get done, and we can be more definitive in terms of our thinking about going forward? Is there a time frame that you're thinking about for next year?
Yeah, I think when they actually have to debate the the Tax Cut Act that will be expiring, then we should get a better idea of what Congress is willing to do.
Final thought from you?
Yeah, no, I would agree. I think yes, we'll have more clarity just because more time will have passed, but I think we're going to have a lot of uncertainty over the next year, 2 years, 4 years. So yes, more clarity, but not all the answers that we're going to need.
Keeping us on our toes again. Thank you both so much. So appreciate we could kind of finish up with the fixed income trade. It's been such an important one, no doubt about it, and something we've been following so closely. Kathy Jones, Managing Director of Fixed Income Strategist. Colin Martin, Director of Fixed Income Strategist right here at Schwab Impact.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business App. Or watch us live on YouTube.
Plenty ahead in our second hour of the weekend edition of Bloomberg Businessweek as we continue with our coverage at Schwab Impact 2024. It happened about a week and a half ago. We were out in San Francisco.
There, we were surrounded by some 4,500 attendees at Schwab's annual conference for independent registered investment advisors and independent record keepers of Charles Schwab. Great perspectives from those managing the money of many folks. And so coming up this hour, investing outside of the U.S. Is 2025 finally the time to diversify globally?
Deja vu, just a little bit, I'm just going to say. Plus, the continued flows and expansion in wealth management and ETFs. First up this hour, going global, as in investing in stocks outside the United States, which for many years have lagged the U.S. market.
Over the last decade, the S&P 500 has returned on average 13.15%, while the FTSE Global All Cap ex-US, which tracks stocks in developed and emerging markets outside of the U.S., has only returned 5.25% on average. It's a difference of nearly 180% over the last decade, so some pretty serious underperformance. It has been hard to beat the U.S. when it comes to equities gains this year and this last decade.
For the global view and where there are opportunities around the world, we checked in with Jeffrey Kleintop, Managing Director and Chief Global Investment Strategist, about what's top of mind for him.
The obsession with AI and stocks like NVIDIA have just really been focused on the U.S. market, and tech has been the best performer in the U.S., and tech is the biggest sector in the U.S., and it's not elsewhere. The other thing is that those other economies have been lagging U.S. economic and earnings growth. That could be different next year, though. We're actually already seeing a shift towards financials leading markets overseas. That could be the next step for the U.S. as well. Big rate cut beneficiary. In addition, we're seeing global economic growth finally begin to converge. U.S. and China expected to slow next year, but Europe, Japan, Canada, Australia, all expected to pick up economic momentum next year, along with earnings growth. As a matter of fact, here in the third quarter, we're just getting done with the earnings reports. Earnings growth for European companies actually outpaced the S&P 500 for the first time in 5 or 6 quarters. So we may be starting to see a turn there.
But what are you seeing in terms of flows? Because it does feel like investors are still holding back and just kind of all in on the U.S. trade.
They are. And post-election, I think a lot of investors believe, hey, we just had an election, I probably need to make changes in my portfolio.
Yeah.
But they can be detrimental. Think back to 2017, right? So coming out of the 2016 election, America First policies were thought to really help U.S. small caps and really hurt emerging markets. The exact opposite occurred. Emerging markets were the best performers in 2017, small cap U.S. the worst. So not saying necessarily it's a perfect play, again, a repeat of all of that, but the flows can be misleading.
What happened last year? Because we were thinking about our conversations that we had with you and some of the other members of the Schwab team. You were bullish on international.
I was, yeah.
What happened last year that you think, okay, was a surprise or just why it didn't pan out? Or you misread the tea leaves?
Well, a few different things. One, I think the technology thing has just run longer and harder than I thought it would. I thought we'd see a broader market.
AI trade in particular.
Yeah, exactly. And so we didn't see that broadening. I think we're starting to see some of that now, but we just didn't. The other thing was we did see a stumble in the manufacturing recovery. So I was basing this on what I call a cardboard box recovery, that demand for making things and shipping things would pick back up again. It did in the first half of the year. It rolled over sharply in the second half. And the Global Purchasing Managers Index for manufacturing back below 50. I think that usually is a lag with central bank policy of about 9 months. We're at the turning point there where I think that starts to pick up next year. So I think it's delayed and not disrupted.
Where do tariffs come into this equation?
Boy.
This is a tough one.
Where do they not?
If you're thinking international, you're saying, wait a second. Okay, we get this America First policy coming once again, starting in January 20th. Mm-hmm. There's a lot of Republicans in Congress right now who look like they're ready to help the president-elect push through that agenda. What do you do if you're an investor outside of the U.S. and you're saying to yourself, wait a second, these companies outside the U.S. could be hit with tariffs.
Yeah, and the numbers are scary. 60% on China, 20% across the board, 200% on John Deere tractors coming from Mexico. If you add them all up, and you weight them by their import percentages, you get a 26% import tariff in the U.S. on average. That's up from 2.6 right now. That's like Smoot-Hawley level, Great Depression era level tariffs. But I think the reality is going to be quite different from that. I'd look, as an example, in Europe. So Europe on October 28th just slapped 45% tariffs on electric vehicles from China. Within 2 days, Chinese delegates were there working out a way to get rid of those. They seem to make some technical progress over the last couple of weeks, maybe scrapping those tariffs in favor of import quotas, which is a far less disruptive way of doing things. So I think that's probably maybe a way we can look at what the future path of tariffs might look like.
Jeff, how do you think about the pushback in globalization? We have a lot of CEOs say, listen, it's not going away. Yes, supply chains are changing. We're doing more nearshoring or onshoring. But I'm just curious how what's going on in globalization, wars around the globe, how that is impacting the international investment play.
So it seems like there are multiple supply chains now instead of just one, right? So you don't just assemble your product in the cheapest labor market. You're going to have multiple supply chains. And that seems to be what's happened.
Is that good for companies' costs, their earnings, what their balance sheets look like, for their investment potential?
It's less efficient, so it should be more costly. At the same time, we've been able to miniaturize manufacturing globally in a way that's made it not as inefficient to have multiple supply chains as it used to be. And with perhaps AI, robotics, a number of these potential innovations, we could maybe scale that even further to where it's less of a drag on corporate profits.
Interesting. Okay, so how do you see this happening outside of the U.S. versus inside the U.S.? If we're thinking about the companies that are doing this type of innovation, who are the beneficiaries here?
Well, I mean, I think it's those that are really looking to scale up their productivity per worker. So you're looking at healthcare, you're looking at financial services. Those are two areas very much more representative outside the U.S. than inside the U.S. So the potential for productivity gains, I think, are skewed to those businesses. Financials are the biggest sector outside the U.S., and there's a whole lot that can be done with AI there.
All right. We know you don't do individual stocks, but when you look at around the world, and I do feel like I just want to talk some regions. I think about Japan, and I do feel like the momentum this year has definitely changed on Japan. Give us kind of your thoughts about what we see in 2025.
So I think you see rate hikes from the Bank of Japan. And so I think that begins to bring some strength back to the yen, and we start to see some capital come back to Japan. We've got a number of businesses really ramping up their share buybacks and their dividends, and so the return to shareholders seems to be picking up. And so if we get a manufacturing recovery, that's what Japan does.
Right.
And so if we get that global manufacturing recovery, I think that does disproportionately benefit Japan.
What about Europe in terms of wars and stuff? So what's the kind of smart, I hate to put everything into a bucket because I don't think that's fair, but what are you thinking about for 2025 in terms of where are the pockets of opportunities in particular for investors and where maybe not so much?
One of the things I think Europe might look to do is buy U.S. weapons to fund the war in Ukraine, to narrow the trade deficit with the U.S., avoid across-the-board tariffs, and actually achieve maybe their objectives in keeping Russia at bay. One of the things I think that's interesting is European automakers. They could be in the crosshairs of Trump tariffs, right? The stocks fell 7 to 9% right after the election, but they've stabilized. They've started to rebound because I think if you look at what's likely to occur, maybe we go from a 2.5% tariff on European cars to 10%. That will be equivalent to the U.S. tariff. That 7.5% increase in tariffs has already been offset by the fact that the dollar's up 5% versus the euro, right? So we've already kind of adjusted for some of those factors, and I think therefore that 7 to 9% decline in those stocks may be further reversed.
What is the region of the world where you're most optimistic?
I think it probably is Europe. One thing, because price-to-earnings ratios are pretty attractive. They're below their 10-year average.
So just great good deals, valuation.
Yeah, I mean, take a look at the difference between Coke and Nestle. Nestle trading at a 4 PE discount to Coca-Cola. They have literally the same customers and operations around the world, but you're paying a big premium for Coke because the investor base is different. So I think that comes back. I think earnings growth does pick up next year. We're already starting to see signs of that. And then 5 rate cuts by the ECB by June of next year versus maybe 2 for the Fed. I think that ease of financial conditions really does help to support that rise in PE.
I'm glad you went there because I do think a lot about the differences in central bank policy, right, based on their specific outlooks and what that gap means in terms of opportunities for investors. And you're saying that spread between what Europe does in terms of monetary policy versus the U.S. could provide opportunities.
It's a drag on their currency versus the dollar. Obviously, the dollar would go up, but maybe that's a few percentage points. Each point of PE expansion in Europe from 14 is a 7% gain on prices. So you get 1 or 2 of those, and that's going to outweigh anything you're going to get in terms of currency drag.
I want to go back to Carol's question about the war, because if you are most optimistic about Europe, how do you factor that into how you're thinking about the region? Because there is a chance that with the incoming Trump administration and the rhetoric around how they want to support Ukraine or they don't want to support Ukraine, that there could be a risk of that war ending and Ukraine losing.
There certainly is a lot of uncertainty over the course of next year in terms of where they draw borders in some type of ceasefire agreement. And in anticipation of that, both sides trying to, gather territory and try and redraw those lines. Ukraine is funded through 2025. Most governments have already committed those resources. There's a lot of weapons on the way. So the whole idea of a day one ceasefire probably doesn't seem likely, but somewhere over the course of the year, perhaps, where those lines are drawn, I don't know. But I do believe that there's going to be a lot more spent in terms of defense in Europe, and that could have some stimulative aspects.
Jeff, we've all been doing this a long time and seen a lot of different market cycles. And I'm just curious how you're thinking about, the investment environment for the international play or global play today versus kind of where it was a few years ago. Is it more difficult? Is it more transparency? Give me some thoughts on that. You've seen a lot of market cycles.
Yeah, so this one is so much tied to sectors, I think. So the U.S. is basically a tech ETF. And nothing wrong with that. It's just recognizing it. But there are other countries that align with a particular sector as well. Germany is an auto ETF. Australia is a metals and mining ETF. Canada is a financials ETF. So if you think about sector diversification, you may love the U.S., but honestly, it's a tech ETF. So if you want some sector diversification, move away from just what has become really kind of a really concentrated AI play, you need that international diversification in your portfolio. And that's a different way of thinking about it than maybe in the past.
30 seconds on China.
China is very likely to slow next year. They're not allocating the resources to the consumer and to the property market. It's still a strategic focus on self-sufficiency and semiconductors and so many other things. So slower growth, but not really rebound.
What type of ETF would it be?
Yeah.
What? At this point, maybe an infrastructure ETF. Yeah.
Do you still feel like we're lacking transparency in China? Just got about 20 seconds.
I think it's getting better. I don't think the same incentives to create the same type of economic data that we create in the West. Yeah.
All right. Great stuff. Thank you so much.
My pleasure. Thanks
Around the world we went. Well done. Well done. Jeffrey Kleintap, Managing Director, Chief Global Investment Strategist at Charles Schwab, right here at Schwab Impact.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business App, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
UBS recently out with a report. It found that millionaires already accounted for 1.5% of the adult population analyzed by the bank in 2023. And by 2028, will have risen in 52 of the 56 markets it surveyed. Now, in some markets, the number of U.S. dollar millionaires will increase by as much as 50% over the next 5 years. That's a lot.
It's all kept those involved in the wealth management business pretty busy. Client assets at retail brokerage Charles Schwab and the wealth arms of the sixth largest U.S. bank surged $5 trillion in the 12 months through September. It represents a 23% jump as the group's revenue from the business collectively topped $84 billion so far this year.
All right, Tim. So a lot of wealth creation is going on, a lot of wealth management going on to manage it all. And that's something we talked about at Schwab Impact, held recently in San Francisco. We did that with Omar Aguilar, the Chief Executive Officer and Chief Investment Officer of Schwab Asset Management.
We see a continuous need and continuous demand of clients for advice. I think as people continue to grow in their lives and they continue to accumulate wealth, the need for them to have somebody they can rely on and continue to just work on what do I do with their money? How do they actually set up? And, it's kind of interesting with all the information that is available today, there's not a lot of people that actually can make a decision on what to do with their money.
Seriously?
And it's just difficult to do.
Why? What is it that they're lacking? What kind of information are they seeking?
I think it's almost like when you go grocery shopping. There is a lot of options. Back when I started my career, you wanted to save for retirement, there was one option. Just buy a target date fund. That's it. Based on what year you're going to plan to retire, That's one option. But now, today, there's multiple options, multiple things. You can do managed accounts. You can do it on your own. You can do a model. There's several things that you can do. And therefore, there's a natural human bias that tells you, oh, well, if there's too many options, I'm overly done. I cannot make a decision. It's almost like me trying to find a shampoo. It's like, no way you can actually pick something that will be good. And then once you pick it, there is a regret. It's like, well, did I pick the right one? Did I not pick the right one? Maybe it wasn't that, or the price. And that's a big part of the same thing happens when it comes down to finances and when it comes down. That's why there is what we call a bull market for advice. Especially when you accumulate wealth, there is a significant amount of need for clients to reach a financial advisor or an RIA to be able to just find what is the right solution for them.
What's interesting, though, is Charles Schwab offers both of these sort of different areas. You could do it all yourself using Charles Schwab's retail brokerage platform, or you could use an RIA whose back end is supported by Charles Schwab. How do you support both of those things, even though they offer very different things?
Yes, well, that's a big part of, the institutional knowledge of trying to do things through client eyes. And in many cases, there's many clients that, want to use their tools on their own. And in many cases, they actually know what they want to do and they're looking exactly what it is. And just thinking about, like a supermarket, there's people that know exactly the brand they want, exactly how they want to do it, and they're loyal to what their pieces are, and they will continue to do that. There are others that are feeling more comfortable, relying on an advisor for them to find what their path is. And, both of them are reliable. Both of them are actually things that I have. There's some clients that like to trade every day. There are other clients that want to buy it today and forget about it. So there's a lot of flavors for everybody.
Omar, in the wealth management business, I'm just curious how many people are, find it, park it, leave it there. They're thinking longer term. But increasingly, we see people wanting access to the private markets, private credit, alt assets. How much of that is at play with you guys too?
Well, it is a big part of the market. And I think to the first part of your question, there's a lot of clients that like to have what we call a financial plan, that would like to have an asset allocation, that would like to have a long-term setup. And, the majority of clients and our philosophy encourages for everybody to have a financial plan. Everybody should have a financial plan. And then once you have a financial plan, you can set up your long-term investment objectives on what you're investing for. And in many cases, it could be retirement, it could be income, it could be, growing, it could be buying a house, it could be a lot of things that you can do and then put the money to work that way. Now, that being said, the human part of every investor and every client basically shows that when you hear the word cryptocurrency, Bitcoin, you hear the words AI, you hear them, immediately you pick up the phone and say, how can I be part of it?
Do your clients do that?
Of course, they do that all the time. And they do it all the time in any situations where they have, and then, how much exposure I have to the Max 7. Do I need to get out of the Max 7? Do I need to hedge my... So the normal setup of a human behavior to try to act on recent information is something that happens all the time.
What's the pressure that your clients are feeling when it comes to fees? And when I say your clients, I mean the RIAs and the wealth managers who are out there offering their services for a percentage of the assets that they're managing on your behalf. Because there are a lot of robo-advisors out there, including a robo-advisor from Charles Schwab.
Yes. Well, what we have done, we have run these studies over time that basically show what clients are looking for. Number one, yes, they're incredibly price sensitive. Price and cost is a big part of the driver for decision making. Transparency is a big part. Going back to the other question you had about private markets, that's a little bit of the hesitation today for clients to try to get more access to it. They're interested. They actually like to have it.
But they're cautious a little bit?
But they're cautious about it because of the transparency and the liquidity. And in many cases, once you explain that there is less transparency and then less liquidity for a private markets, then they step back and say, oh, let me think about it. I mean, initially sounds great and initially sounds like a great opportunity. And in fact, we encourage, a portion of their investments to be in private markets. However, once you explain the trade-offs, then it starts to just, make a big difference.
I kind of love to hear that because I feel like we've spent so much time at various investment conferences and everybody just wants to talk about private equity and in particular private credit. But a lot of folks are saying, you got to understand that you lock your money up, you can't get access, and the transparency issues are maybe not there. So it sounds to me that like your investors are savvy enough to be asking these questions.
Yeah, no, and not only that, but the big part is like, the investors like to see, especially younger investors, they like to see data. They like to see information, before they make a decision. And this is a very interesting.
Are you looking at Tim as younger investors?
Yes, exactly.
Are you not looking at me? I'm just
looking at both of you. But when I actually think about it, when we do studies by generation, like silent generation baby boomers, they tend to be a little more trusting in that sense. And in other words, like they trust the advisor, they have a relationship with the advisor, and they don't necessarily need to have that much evidence. And this happens actually with my kids. Even when I recommend a restaurant, they still have to Yelp it and try to figure out what the stars are. And in many cases, like that, why do you recommend that it only had 3 stars? So it is one of these that they suggest evidence. They need evidence to make a decision. And in those cases, when you compare performance on private markets and public markets,
right,
you immediately start saying, like, why would I lock my money in where I can actually in there? Now, that's not the whole story, but I think that's a little bit of the hesitation.
We teased that we were going to ask you about key behavioral biases to be on the lookout for in today's environment. What are they?
Say that again?
The key behavioral biases that are out there in today's investment environment.
Well, I would say there's 3 that are incredibly, prevalent in today's market. Number 1 is herding behavior. Herding behavior, which is exactly what we're just talking about. And the Mag 7 was clearly a big part. AI, Mag 7, Bitcoin.
NVIDIA?
Definitely, part of, what's going to happen. A lot of people will be watching this afternoon, or actually in a few hours, just on that report. But that component about that, and in fact, for that particular thing, not a lot of clients knew what NVIDIA was 5 years ago. It's not until now that it became so popular, and that's a big part of what is called the FOMO, and that's one of the biases. The second bias is called recency bias, which is people tend to just, look at the most recent information and extrapolate into the future. Oh, the market has been up for 3 months. It should be going up forever. And that's the kind of behavior that people tend to have. Or the same thing goes back, to when things go wrong. It's like immediately they become like, well, if we have had two bad deals, it's time for get out, and then try to just panic that way. And those are 2 of the typical, behavioral biases that are very typical today.
Carol mentioned crypto, so I got to ask about Bitcoin.
So everybody's doing a show that's just about crypto.
Tuesdays noon Wall Street time. Feel free to tune in. But it's interesting because it's the whole market of Bitcoin, the whole market cap of Bitcoin, not even the market cap of NVIDIA. So I think a lot of people would say there's still a lot of room for people who are crypto curious at this point. What portion of an investor's portfolio, if any, should be allocated to crypto?
Well, we have had points of view on crypto in general to basically say, like, look, any client could actually use trades as a way to just generate or try to find any solutions they have. For any strategic long-term asset allocation, we haven't adopted crypto as being part of like what you would use for the long run. And in many cases, the reason why is because for our strategic asset allocation work, we normally try to find what are the fundamentals that allow that to be valued and what are the economic factors that drive the performance of certain asset classes. You compare NVIDIA to crypto. Well, in the case of NVIDIA, there is earnings, there is clearly financial situations, there are results, there is everything else. In the case of crypto,
there's actually regulatory SEC filings, right?
There is, exactly. And they are accountable
and for cash flows.
And cash flows. Lots of cash flows.
And actually, there is a product out there that you can touch.
Right.
In the case of crypto, a lot of these prices tend to be driven by supply and demand. It's supply and demand driven. It basically people have asked me the question, say like, well, but isn't gold the same? Like gold is also supply demand driven? Yes, it is. But the difference is that there is a bar that you can touch.
Omar, 20 seconds. Top question you think on everybody's mind are registered investment advisors right now in this environment? Number one question, investment question.
The number one question is, what would we think about the market, next year, given, potential less regulation, potential, tariffs, and potential changes in the way that, the SEC, will move down their agenda next year.
All right, good stuff. Thank you so much.
It's good to see you guys.
Great setup for us here on this Wednesday. Omar Aguilar, he is the Chief Executive Officer, Chief Investment Officer of Schwab Asset Management, joining us here at Schwab Impact in San Francisco.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business App. Or watch us live on YouTube.
The insatiable appetite for the investor-friendly wrapper, an all-time high number of product launches, and a relentless bull market fueled by Donald Trump's presidential victory have helped push total net inflows into U.S. ETFs past $913 billion. This is according to data compiled by our Bloomberg intelligence team. That beats 2021's record haul with still one more month to go.
Further signs of the market's exuberance. Total U.S. ETF assets hit the $10 trillion mark for the first time in September. More than 600 new products have debuted since the start of the year, and nearly all ETFs in the U.S. posted positive 12-month returns, up from 8% just 2 years ago. This according to data from Bloomberg Intelligence.
Now, Schwab started in the ETF business 15 years ago, and it is one of the dominant players, with 31 ETFs, including 10 fixed income offerings, making it the fifth largest provider of ETFs.
With an ETF update, we were joined by David Bodsett. He's Managing Director and Head of Innovation and Stewardship over at Schwab. He stopped by our setup when we were at the Schwab Impact event out there in San Francisco.
You know, the first thing we start with is, what are the investor needs? You know, that's at the heart and the ethos of everything we've been doing in ETFs for the past 15 years, you mentioned, and that's really helped compel us to up to $400 billion in assets in our ETFs. So we've been doing an annual ETF investor study now for over a decade. That's asking questions of both ETF investors and non-ETF investors about their various views on how do they think about ETFs, what's most important to them about what they're investing in, and what categories they may invest in the future. That provides us a lot of great insights to help drive our innovation in the space.
All right, so for non-ETF investors versus ETF investors, what they want, is it different?
You know, there are some nuances to that. So in some cases, it's very much the same. It's things that they're looking at when they're selecting an ETF, like cost.
Yeah.
Right? That stands out in both categories. But there are other areas where we see non-ETF investors, they need more education, they need more insights, because their confidence level in selecting an ETF is much less than those that are ETF investors.
Makes sense.
It does.
Hey, listen, one thing that they need is a mortgage-backed security ETF, which just you guys launched this week, 1 day ago, yesterday?
Yes, it was.
So tell us about that.
You know, when we listen to our investor base, the one thing that they tell us is, we need more precise tools for our fixed income allocation. You know, we go back a decade and everybody was using the aggregate index to get their fixed income exposure. But in a dynamic interest rate environment like we're in today, they want to control for sector exposure. They want to control for duration. They want to control for the credit quality in their portfolio. Mortgage-backed securities is one of those that frequently are utilized in a portfolio, but they think about, how do I redynamicize that aggregate exposure? They want that precision in an MBS ETF.
Are you thinking about getting into what our own Eric Balchunas over at Bloomberg Intelligence calls the hot sauce ETFs?
What's the hot sauce?
If you got 95% of your portfolio, you know, in large cap stocks and maybe some bond funds, you got 5% to play with. Maybe you throw some into ARK, or you throw some into Bitcoin ETF. Are you guys thinking about getting into that sort of specialty category? Maybe go leveraged NVIDIA ETF?
You know, our bread and butter largely is in the core.
He sounds like an ETF analyst. I'm impressed.
I listen to Eric Balchunas.
He does. Eric's a great guy.
He is a great guy.
Love to work with him. But, you know, our bread and butter is really in the core products and solutions, right? Because where we see the benefit that we can provide as an ETF provider is on cost, which is number one in our survey year and year again.
Cost.
The number one thing people look at.
So there's a race to the bottom with those sort of big, broad ETFs, because there is so much competition. And that's why I think you see a lot of innovation happening in how can we make our product unique?
Yes.
And also charge 50 basis points instead of 8 basis points.
Yes. Well, I think you'll see us innovating in that space is less on those hot sauce areas, and it's more thinking about, how do we use the ETF wrapper in other ways? Bring actively managed strategies. You know, earlier this year we launched the Schwab Ultra Short Income ETF. You know, you look at that ultra short space, it's really hard to index that category.
Right.
We also think it's an area where an active manager can potentially provide alpha.
Is it all about active going forward?
You know, I don't think it's all
Actively
about
managed?
active, but increasingly you're seeing that in that space. That's either coming through new launches or conversions of active mutual funds into ETFs, and they're taking an outsized portion of the flows this year.
I always think about this, David. I began kind of my career in business news.
You had a show, an ETF show, right? Or a mutual fund show.
It was a mutual fund show not so long ago, and it's just interesting to see the arc. And how we move to ETF. When is it that we just don't have mutual funds and it's all about ETFs? Is it just a matter of time?
I don't think so.
Why?
I think there's
Why? Why do we need both?
It's all about the benefits the ETF provides. It can provide a cost benefit. It can provide a tax benefit because they tend to be more tax efficient, and a trading benefit. But in many accounts where it's a qualified account, you're not paying taxes, that tax benefit isn't there. You also see a lot of strategic allocations.
So longer term, like
longer term investors, 401k plans, retirement plans, where you may not necessarily need that tax benefit or the ability to trade every day in your allocation if I'm more of a strategic investor.
Are investors, though, who are planning for their retirement missing alpha, though, by doing mutual funds that way? Like, I mean, are they missing out on opportunities potentially?
I think potentially and increasingly they may miss out on those opportunities because the innovation is going to be more in the ETFs than it is in mutual funds. So in those new opportunities that arise.
What about money market ETFs versus money market mutual funds?
You know, it's interesting. We're seeing some work by other firms in that space. It'll be interesting to see how.
But right now,
that
if I
evolves.
want to buy a money market fund at Charles Schwab, I have to buy a mutual fund.
It is in a fund structure. That's right.
Why is that?
Well, I mean, I think the people like the dollar NAV. Right? That's one of the big distinctions we've seen with the one product that is in the market today. You're no longer trading at a dollar like you do with a money market fund. It's dollar in, dollar out. You like that known factor. And I'm not sure that investors will necessarily want to stray for that when they think about their cash investments.
How does the macro play into the ETFs that you guys are thinking about in terms of launches?
You know, for us, it's really about the long-term view. It's less about a macro current point in time. It's really thinking about how do we serve investors' needs for the long haul.
So even like, you know, a new administration, new policies that might impact the economy and various sectors, it's not the way you play it.
It's not the way we play it. That's right.
All right. Interesting. Does the macro view, though, I mean, as you look at what's going on in the space, how does it impact at all your thinking?
Yeah, so I think where it impacts our thinking is when we talk to investors about how to allocate their portfolios.
Okay.
Right? You think about our...
Do they have lots of questions right now?
Oh, absolutely.
Let's say you were to just think about the universe of ETFs in your world. How much of those ETFs are, when the money comes in, is it about indexing versus about something outside of indexing to try to get alpha?
You know, I think it's the way that indexing is used, right? Model portfolio, strategic allocations. It's more about how do I tilt between large cap and small cap, domestic, international, looking for those alpha opportunities rather than within the asset class itself.
We mentioned you guys, 15 years, just celebrated your anniversary from your first ETF. How do you think about the trajectory and kind of where the ETF market was at the beginning? I remember a time I felt like every guest or every other guest was somebody offering up a new ETF. I feel like it's found a different groove now and it's matured, but tell us about it. You've been in it.
Yeah, I've been in the ETF industry for nearly 20 years, so it's been a long time. It's been a great run, but we've still got a lot of innovation to go. So I think we're just in the early innings still of what the ETF can bring to investors.
NVIDIA ETF, is it coming anytime soon?
They have, I think, Direction.
Yes.
Is it Direction?
There are some single stock levered ETFs in the marketplace.
That's what I was thinking of when I was referring to that leveraged NVIDIA
ETF.
You
were channeling your inner Eric.
He was indeed. David, thank you so much. Fun to check in with you again.
Thanks so much.
I hope Eric is listening and knows that I'm giving him all this love.
He better. I'll point it out to him.
Come on, Eric.
David Botzett, Managing Director, Head of Innovation and Stewardship over at Schwab, joining us right here at Schwab Impact. David, thanks again.
Thank you.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business App. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.